Senior Vice President and Managing Director of Granahan Investment Management in the US, Drew Beja, will explore how he seeks desert island investments among the US small and mid-caps.
Well, thanks, Ray. I'm sorry I couldn't join you all together in London this year, but hopefully next year we'll be able to do that. And in the interim, it's a privilege to join you all at Think Tank this year in this format. I'm Drew Beja. I work for Granahan Investment Management. We're a small boutique investment firm based outside of Boston, Massachusetts. We've been in business for 35 years, and we do one thing: U.S. long-only small to medium growth stocks. We're independent, employee-owned, and have a very collaborative team. I manage the U.S. focused growth strategy for Granahan, which many of you and your clients are invested in. And I'm invested right alongside you. I started this fund in 2007 with my own capital, and I've never taken a dollar out, and it represents a very large percentage of my net worth. I've got a newsflash for you. We're living in a rapidly changing world. We've got drones which are delivering goods from Walmart and Amazon. We've got drones delivering human organs for transplants. We've got people, at least for now, delivering food in minutes to our door. Someday I'm sure that'll be drones pretty soon. We're in a world where there's artificial intelligence, virtual reality, machine learning, and chatbots. And of course, the magic of TikTok, a world in which the sharing economy has become mainstream and produced a whole lot of successes and some failures. We're in a world where money's changing hands and being invested in all sorts of new ways. Where millions are playing video games with each other real time all over the world. Millions of others are watching others play video games and esports, and where somewhat belatedly, Americans are finally beginning to be able to bet on sports from their homes. And all this predates the global pandemic, which has descended upon the world. And thus, today we're dealing with even more. COVID's wrath causing deaths and illnesses, business failures, unemployment. It also seems we're experiencing once in 100-year natural disasters every 100 days or so. We've got unhinged teenagers playing vigilantes in streets with automatic rifles, and we've got unhinged egomaniacs off the streets sitting in what is arguably the most important office in the world. So the headlines are scary. The numbers are scary. And lots of them are going the wrong way, which is why investors can't be blamed for feeling a bit frenetic about these times. And yet, it's just such times that your clients are lucky to have you helping them navigate. It also helps to have a guiding light, a North Star, so to speak. For us, for the Granahan Focused Growth Strategy, that North Star is simple. We invest in companies that we'd take if stranded on a desert island for 5 to 7 years, because these companies tend to have a number of critical attributes. First, they have large opportunities that will enable them to sustain high growth for many years. Second, we spend a lot of time getting to know the value proposition that the company is delivering, whether it's a B2B, B2C, it's a product or a service. What's that? What is it that the company's delivering? What's the customer paying? What are their switching costs? What are their alternatives? We also get to know the management teams and corporate cultures. We're looking for companies that can attract and retain talent, that can invest and sustain their moat over time. And we like strong balance sheets because stuff happens. And we like high incremental profit margins because that's a beautiful thing. When we find a company, we put it on what's called the Desert Island Monitored List. There are about 100 companies on that list, and the portfolio is about 40 stocks out of those 100. And you might wonder how we find them. Well, there are 7 of us on the investment team at Granahan, and we've been investing in small caps on average for almost 30 years. We have each developed very large networks And we come across and meet with hundreds of companies every year. But very few of them have the attributes that I just mentioned that make them desert island worthy. We all know now in hindsight which companies we should have taken to the desert island 10, 20 years ago. Companies like Shopify and Salesforce and LinkedIn. And we owned most of the companies on this page, no, not all of them. But that's not the main point of this slide. The main point is to emphasize that our mission is to deliver a portfolio of tomorrow's desert island companies today. These tend to be companies that are on the right side of disruptive change. And you hear a lot about disruptive change these days. I like to think of it as a wave or a tide. And most companies are swimming against that tide, 95, 97% of the companies. That doesn't make them bad companies or bad people or bad stocks even. We're just not interested. We want companies that are swimming with the tide, kind of riding the wave, or to shift to another water-based metaphor, we like to fish for secular growth companies in ponds or industries that are stocked with these secular growth companies. So we're invested in areas such as cloud computing, e-commerce, edtech, artificial intelligence, and cybersecurity. And these are areas that have been growing secularly for a long time. And COVID, in most cases, has accelerated that growth. For example, the move from offline to online, which has greatly benefited companies like Shopify, a platform for online commerce, at the expense of bricks and mortar retailers like Lord & Taylor and Neiman Marcus, which have been struggling for years, and COVID tipped them each into bankruptcy. Another example is Etsy. Sales on the platform were hurt early in the pandemic as customers worried about all sorts of things. But quickly, Etsy's 3 million sellers pivoted to selling masks, and the results have been stunning. Through June 30th, $350 million of masks have been sold on the Etsy platform. And perhaps even more impressive, sales excluding masks are up 90% year on year as buying has shifted online. Cloud computing has been underway for almost 2 decades, but COVID has vaulted it from a nice to have to a need to have for most businesses. And similarly, online education has been experiencing growth for many, many years, but COVID has accelerated this trend for obvious reasons. My 85-year-old dad had his first telemedicine visit a couple of months ago. He'd never have done that without COVID. And my 84-year-old mom is now a whiz on Zoom. Ditto that. In a moment, I'll briefly walk you through our 4-step process and share a few examples of companies we believe are desert island worthy today. But first, an overview. And I believe this is the most important slide in the deck because it captures the philosophy and process underlying the Granahan focused growth strategy in a simple graph. First, it's important to distinguish companies from stocks. Companies' fortunes are not linear. Even the best don't grow in a Bernie Madoff like 12% per quarter steady line. That's represented by the blue line, the sine wave there. And we certainly know that investors' perception and psychology can cause stocks of even the best desert island companies to swing even more meaningfully than the company's fortunes. Think about Apple's near-death experiences, first in 1997, and then in 2000, before rising like a phoenix from the ashes after introducing the iPod in 2001. And today, or last month, Apple became the first company to reach $2 trillion. So our investment process essentially aims to do 2 things. 1, identify these desert island companies going up and to the right. And 2, own the stocks of these desert island companies when risk reward is good and not when risk reward is bad. This compounding of the companies growing 15, 20, 25% per year is powerful. Let's take 2 examples. Company A in the orange grows 4% per year, about twice as fast as US GDP typically grows. And company B grows, say, 20% per year, which is actually a bit less than the average growth rate of the companies in our portfolio. After 5 years, you'd have made 22% on company A and almost 150% on company B. And after 10 years, the results are even more stark. Just under 50% on company A in the orange and over 500% on company B. Now, I'm not telling you anything that you don't already know, but the numbers are stark, and I like to remind myself once in a while of the power of compounding, which is why I believe a secular growth portfolio merits a place in most asset allocation plans. The compounding has worked well for investors in the Granahan focused growth strategy. Again, the strategy launched in 2007. $10,000 invested in the strategy 13 years ago would be worth almost $113,000 today. So compounding is powerful, but you need to be disciplined. So there are 4 steps to our process. It's pretty straightforward. First, company analysis, i.e., is the company desert island worthy? Number 2, the stock analysis. And here I'll walk you through an example of what we call our expected return and how we manage risk at the stock level. Number 3, portfolio construction. And we'll talk about how we allocate basis points and manage risk at the portfolio level. And number 4, risk management is integral to the first 3 steps of the process, but then we also step back, and there are a number of checks and balances, and I'll touch upon those. So let's start with the company analysis. And again, we separate companies from stocks. Let me give you an example of a company that we believe is desert island worthy. I'll bet most of you know Axon, even though you may not know the name. The best known of Axon's products is the Taser, the non-lethal weapon that has the leading position in that business worldwide. Taser has a very ambitious mission. By 2030, they aim to obsolete the bullet, which is a pretty big mission. They also want to use artificial intelligence to eliminate paperwork for law enforcement officers. Number 3, they're going to use their cloud and Internet of Things capabilities to leapfrog communications and allow police officers or law enforcement officers more broadly worldwide to communicate effectively with their dispatchers and headquarters and spend more time on the streets. And number 4, in a broader sense, Axon aims to work with the public, police departments, municipalities to reimagine public safety. Big ambition, and it's large. This opportunity is estimated at $27 billion. You can see there are 4 growth areas. There are pictures of, in de-escalation, the Taser weapon on the left. Video cameras, 10 years ago, Axon entered the on-officer video camera business. And they've gone from a non-existent player to the leader in body cameras. Productivity tools, using their Axon Records platform. And then communications to bring it all together. I've got a short video I want to show you that shows a little bit how it comes together today. And everything you're going to see is available today. And in the future, it's even more ambitious. As I mentioned, we like companies that have strong balance sheets. Axon has almost $700 million in cash and investments and no debt. And while they're profitable today, they are under earning, but they're generating strong free cash flow and they have very strong incremental margins. I'll come back to Axon in a minute to talk about how we value it as a stock. But first, I thought I'd share with you a few other companies on the desert island monitored list. We all know how social is becoming increasingly mission critical for brands to connect with their customers and vice versa. And it's critical for these brands to manage that social presence. Sprout Social is the leading platform for brands to do this. Kornit is leading the way in providing machines and systems to enable customized digital printing on t-shirts and other textiles. Or put another way, Kornit is disrupting the centuries-old analog textile printing industry. Vital Farms is an ethical food company that is the #1 brand of pasture-raised eggs in the U.S. #2 in overall sales and by far the fastest growing. Enphase is a company which has moved from a component supplier of inverters of residential solar systems to a complete all-in-one smart energy solution. And then there's One Medical, which is in concierge medicine, where for less than $200 per member per year, you can wait just 30 minutes to see your primary care physician, or get in quickly to see a specialist, or better yet, visit one immediately via telemedicine. Note, all these companies are secular growers, and while most aren't immune to the immediate effects of COVID, the pandemic, if it's anything, accelerated adoption. Yeah, even Vital Farms, adoption's accelerated. We're eating more eggs these days, if you wonder. But just because a company is a desert island company doesn't mean the stock is attractive. Let's go back to our friend Axon. Only now we'll shift from analyzing the company to analyzing the stock. This is a busy page, but essentially what I want you to understand is how we use a multi-scenario probability-weighted expected return. Importantly, this forces us to analyze not only the most likely or good scenarios, but to talk through, think through, work through what might go wrong, why, and the impact on the stock. So there are a lot of numbers on this page, but the two key numbers are, 1, downside risk, 27%, and 2, what's our probability weighted expected return, 30%. Okay, so Axon's a desert island company. The stock has an attractive expected return and a favorable risk reward. We're done, right? Buy a lot of it. No, we're not done. The third step in our 4-step process is to evaluate Axon from the standpoint of the portfolio. As I mentioned, investors who own the Granahan Focused Growth portfolio own about 40 stocks out of the roughly 100 companies on the Desert Island Monitored list. So what's our process for deciding whether Axon, Kornit, or Vital Farms merit a place in the portfolio? Well, there are many factors to consider, but in the end, these factors can mostly be boiled down to 3 categories: conviction, risk reward, and diversification. And I'll speak to each briefly. First is conviction. You can have 2 companies, let's say A and B. Let's say they're in the same business, but you've known one for 15 years and one for 2 months. We're naturally going to have more conviction in the expected return, in the business model, etc., on the company we've known for 15 years in comparison to the one we've known for 2 months. So the main point here is that conviction matters. Number 2, risk reward. This is very similar. Let's say you've got 2 companies, A and B, they're in the same business. Let's say we've known them the same length of time. They're managed by clones of each other, but company A has big upside in the expected return, but also a big downside. Whereas company B has more limited upside, but you're more protected on the downside. We're going to take company B, where you're more protected on the downside, over A any day of the week. Again, there are a lot of factors that go into risk reward: the skew of the return, trading liquidity, ESG, long tail risks. But the main bullet point is that risk reward matters. And then there's diversification. And here we take a bit of a different slant on diversification because we think we care more about what the growth drivers of a company's business are than where it happens to be categorized by Russell or FactSet or Bloomberg. This portfolio has always had a strong footprint in companies that are categorized as technology stocks, but they tend to have different drivers. To illustrate this, let's rewind the clock 15, 20 years in the gray. And let's say we're magically having this conversation over Zoom 15 years ago. And I'm a portfolio talking about our investments in a retailer, a hospital, a tutoring business, an insurance business, a for-profit education business, and a bank. And I'm telling you how I sleep like a baby at night because we are so diversified. The only correlated risk is that they're delivered in bricks and mortar buildings. And unless bricks and mortar cause cancer or there's a global pandemic, we're good. Well, today we've got opportunities to invest in desert island worthy companies in each of these verticals. Etsy in retailing, Teladoc, telemedicine, Chegg, which is essentially Uber for tutors, Lemonade, which is disrupting the insurance business, 2U, which is a platform which enables bricks and mortar colleges to offer their curriculums online, Q2, which offers small to medium-sized banks the ability to offer their customers online banking and mobile banking and compete with the JP Morgans and Bank of Americas of the world. All these businesses, even though most of them are classified as technology businesses, they have very different growth drivers. And so when we think about diversification, those growth drivers and their correlation, how they're maybe inversely correlated, are what we care about. And step 4, as I mentioned, there are important risk management elements that are integral to each of the first 3 steps of the process. The balance sheet, for example, in the company analysis. The downside scenarios being even more important than the upside scenarios in the expected return analysis. The portfolio correlations and the drivers that I just mentioned at the portfolio level. But then we step back and there are a number of checks and balances. We have risk reports. We look at trading liquidity. There are a number of risk management checks and balances that we have at the portfolio level. So those are the 4 steps of the process. Now there's just one more question, right? How do we factor in our opinion about what the stock market's going to do? Well, answer to that is we don't. When I get the question about market timing or where the market's headed, I always think of legendary investor and Vanguard founder Jack Bogle, who said, after nearly 50 years in this business, I do not know of anybody who has successfully and consistently timed the market. In fact, I don't know anybody who knows anybody who has done it successfully and consistently. Well, if Jack Bogle doesn't know anybody or he can't do it, neither can I. So let's look at some case studies just to drive home this point about market timing. Take 2002, for example. It was a scary time. Shortly after 9/11, we were just nearing the pending invasion of Iraq and lots of reasons to think I should be out of the market now. Well, it turns out in hindsight, that was the time to put your money in the market, not to take it out. Or you could look at a case illustrating the opposite. Suppose you bought at one of the worst times in our lifetime, worst moments, October 07. Shortly thereafter, we plunged into the global financial crisis, and by March of 2009, U.S. GDP was running negative 6%, banks were failing, the auto industry was on the brink, and since we're talking about the NASDAQ, let's note you would have lost 56% from the peak just 18 months ago. If you bought the NASDAQ at that peak, not the bottom, but the peak in October of 07, you've almost quadrupled your money. Another example, August of 2011, Black Monday. The S&P downgrades U.S. sovereign debt. First time in history. There's fears of contagion. And we're only 2.5 years from the global financial crisis. which was so traumatic that people hadn't forgotten. Well, the Russell fell 25% in 12 trading days. And I know several people that were spooked out of the market. But it turns out in hindsight, that was the time to put your money in the market, not take it out. One more. Let's suppose this year, instead of a diamond necklace or a nice watch, you bought your sweetheart the Russell 2000 Growth Index for Valentine's Day. Well, tough timing. A month later, you'd have seen the value of your sweet gift drop over 40%. Pretty sour. And yet, to everyone's surprise, myself included, 5 months later, you'd be back in black. Now, I don't have to tell you this. That's why your clients have you to help them create an investment plan to stick with it. And taking the long view has paid off for investors in the Granahan Focused Growth Strategy. This slide shows the drawdown since 2007. The point is that even if you inadvertently were to buy at the top, you're doing pretty well. And it illustrates that with a disciplined philosophy and process, one can generate returns well in excess of the benchmark. Okay, you might say, I hear you about market timing, but what about valuations? Here, it's important to remember that valuations are about future discounted cash flows. Not past cash flows or current cash flows, but future cash flows, future DCF, discounted cash flow. Here, I like to think of Amazon and Muhammad Ali. Amazon's like the Muhammad Ali versus George Foreman fight in the famous Rumble in the Jungle in 1974, championship bout. For those of you that are too young to remember, Foreman was the defending champ, undefeated, 40-0, 37 knockouts, and a big favorite. Ali spent 7 years in his famous rope-a-dope, taking punch after punch. Seemed like he was getting killed, kind of like Amazon. Amazon lost money or under-earned for 20 years, and they're still doing so today. Many times, folks thought they were on the ropes. But Ali was investing in the future. He was under-earning in that first 7 rounds. But then in round 8, Foreman tired, and Ali knocked him out and regained the heavyweight championship. Amazon wrote the book on under-earning, and now they are the heavyweight champ. They've changed the rules. In the old days, investors looked in the rearview mirror at a trailing price to earnings or perhaps a DCF, but a stodgy glass half empty DCF. Today, investors are looking down the road ahead, not in the rearview mirror asking themselves how, but rather how big could this company be? What can they earn in the future? The DCF glass of such companies is very much 75% or 80% full. And this is particularly true in this time of COVID. And it makes sense. 2020 earnings kind of don't matter. 21 earnings really don't matter. There are too many idiosyncrasies. What matters is what can a company earn in 22, 3, and 4. Now, it's critical that they have the wherewithal, the balance sheet, and the cash flow, and the recurring revenue to make it to 22, 3, and 4. But that's what matters. I want to thank you for taking the time today to learn a bit more about the Granahan Focused Growth Strategy. We are indeed living in the midst of very turbulent times, and your clients are lucky to be able to work together with you to assess their needs, time horizon, risk tolerance, and come up with a sound investment and asset allocation plan. And perhaps you'll believe, as I do, that secular growth merit a place in such a plan, and that together you can help your clients stay the course through these rough seas and navigate their way to their own desert island. Thank you. And I hope next year we can all be together in London and have a nice conversation about this.